Hello everybody, welcome to the November 2020 monthly market report. This is for you if you're a real estate agent needing to inform a client or prospect on the current market, or perhaps a financial advisor needing to do the same, or perhaps you are that buyer or seller looking to make an informed decision. I'm Paulo Rodriguez. I've been a mortgage professional since 2005, and I'm excited to share market data with you so that you can make an informed buying or selling decision, or help your client to do the same. Today, we're going to talk about many factors affecting housing, such as the economic recovery and where things stand, what's going on with mortgage forbearance, and what's happening after people come off of forbearance, the likelihood of seeing a housing crash next year, and the top 3 reasons as to why homeowners are not listing their homes for sale, and some rebuttals to overcome their objections. So let's get started. Here's a quote from the Wall Street Journal, which says, "News stories often describe the coronavirus-induced global economic downturn as the worst since the Great Depression. Yet for many, the comparison does more to terrify than clarify." No doubt, headlines today, news reports, the media do a lot more to terrify us than they do to clarify anything about what's actually going on. And I bring this up because as I talk through this report, you will find that the data is driven by a lot of uncertainty, and that our buyers and sellers are looking to us to help them rationalize why taking action is the right decision. And to do that, I want to go back in time to what I shared earlier this year after the pandemic had set in, what experts were saying about the economic downturn and recovery in the first, second, and third quarters. So if you remember, going back to that time, we saw a little bit of economic decline in the first quarter, significant decline in the second quarter, and then ultimately the forecast was that in the third quarter there would be economic recovery in a V-shaped fashion. So now that the time has elapsed and the data is in, what has actually happened? Did the reputable firms you see in the slide get it right? Yep, they sure did. Spot on, as a matter of fact, so close that you could literally lay these over the top of one another and create the certainty that our buyers and sellers are looking for. So I want to take a look at what has happened during the pandemic, and then get into some very real issues that we're facing right now as a business and as an industry, and what I believe are some of the most important topics currently. The first point I want to highlight is that over the summer, during the coronavirus pandemic, the average FICO score in this country increased. And you might find that surprising. I know I did. And by the way, these are not necessarily mortgage applicants. These are just average consumers. So what could possibly be behind this? Well, there's a very specific reason. And that is that most households have used their stimulus check to pay down debt or to save. 35% of those receiving stimulus used it to pay down debt. 36% of those people receiving it saved that money, and you've probably seen some news stories about deposits rising across the country. And lastly, 29% spent the money. Now, I'm not advocating for or against stimulus, that's besides the point, but I am pointing out that almost 2 out of 3 people use stimulus to pay down debt or save, thereby improving their financial situation, raising their FICO score, and giving them a better mortgage borrowing capacity going forward. And since news headlines do more to terrify than to clarify, I don't think this is something that is being talked about in general. The other thing that's very interesting about the world that we live in right now relative to business is that the number of business applications across the US has skyrocketed this year. And that's really a tribute to innovation across this country, as people have seen where the greatest needs exist for the new normal resulting from the pandemic, and to be able to meet the needs of the consumers in today's market. There is no doubt there have been a lot of businesses that have been impacted in a negative way, but many have reinvented themselves, and many new companies have been born in a similar way to that of the Great Recession. A lot of the great companies that are around today were started from 2008 to 2010, and that innovation was birthed during those downturn years. So I think that's some really positive news I would share with prospects, as it is a testament to the American spirit of innovation and entrepreneurship, which is one of the backbones of our economic engine, and which directly impacts people's ability to buy homes, and therefore impacts our real estate industry. You may recall last month I spoke about consumer spending being at or near pre-pandemic levels seen in January. That metric has further improved this month, as the country as a whole is within 3.7% of where we were on January 1st. You can see that in this map, the majority of states are orange, which means that they are within 10% of where we were on January 1st. And so that is a very, very good thing, not to mention that the states seen in blue are at or better than they were at the beginning of the year. Furthermore, it will be of no surprise if we see an additional stimulus package from the government, and this should further improve consumer spending. Now, the question that is on a lot of people's minds is unemployment. Here are the weekly filings for unemployment across the country since the start of the pandemic in late March. And as you can see, towards the end of March, around 7 million people in 1 week claimed unemployment. And we have since trended very much in the right direction, but we are now hovering in the same place, and we really need to see those numbers continue to come down. Most recently, about 750,000 people claimed unemployment in the last week of October. Now, that was the number of new weekly unemployment claims. So let's take a look at the total number of people receiving unemployment benefits. And this graph actually tells a better tale. You can see that nearly 25 million people received benefits in the second week of May at the height of the pandemic, and that the most recent count was about 7.3 million, which represented a 538,000 decrease from the previous week. And while that's certainly a very good trend, 7.3 million people on unemployment is still unfortunately sobering. Hopefully, we will continue to see that come down, which will of course be a good thing for real estate. If you watch this report every month, you will know that unlike the media, I'm anything but shy of highlighting good news. However, it's also important to keep things in perspective. And this quote from the Federal Reserve helps us do just that. It says, "Data from the Survey of Business Uncertainty suggests that the road forward is going to be a tough slog. Businesses hold tepid expectations for year-ahead employment and sales growth. Expectations are in fact so tepid that based on the latest average projection, it will take firms more than 4.5 years to recover their pre-COVID employment levels." The Fed is basically saying that although we have made strong progress in averting a crisis of unemployment, we're simply not out of the woods, and it's going to take time to do so. I don't think any of this is something that's going to catch anybody by surprise, because a lot of experts have been saying this recovery is going to take time, but it is sobering news relative to the unemployment and recovery picture across the country. And this brings us up to a point that I want to focus on for just a minute, and that is the question that is being floated around our business of, are we going to see a 2021 housing crisis, foreclosure crisis, housing crash? There are people on YouTube, there are articles written about it, posted in different blogs and Facebook groups, talking about a coming flood of foreclosures, REO properties, things like that. And I want to attack that directly and give you the data to have that conversation with people in our business, maybe people that you're working with. And if you're a realtor, your prospects that need factual information to make a buying decision. And to do that, I want to take a look at active forbearance numbers. I've been following this metric for a while. We look at forbearance as a tool given to consumers to help weather economic difficulty. If you go back to the end of May, we had just over 4.7 million people on active forbearance. And as we look at that over time, the number of people in active forbearance is decreasing, and quite dramatically decreasing. Look at the large step down in October, where you can see in blue that we're right at 3 million people for the last several weeks on active forbearance. Now, we want to continue to see people come off forbearance, but the good news is that we've seen a lot of people already come off, and most importantly, not return. At the onset of the pandemic, a lot of people were saying, hey, we're going to see 30% of homeowners take forbearance. Well, that never happened. Back in May, we reached this height of about 8.5% of mortgages in forbearance, and where we sit today is 5.8% of mortgages in forbearance, and that number is dropping. And what we also know is that the percentage of forbearances by product type is decreasing. Look at Fannie Mae and Freddie Mac in the orange line. The blue line is government-backed loans, also known as Ginnie Mae, and that's what FHA and VA loans fall under. And then private label, which is pretty much everything else, including jumbos and non-QM loans, which are typically riskier loans. And despite that, all of these forbearance numbers are dropping. Now, as we see declining forbearance numbers, that in itself is not the complete answer to the housing crash question. I think what we need to do is dig deeper and ask what happened after people came off forbearance. Did delinquency spike? This chart answers that question and is current as of October 20th. Of the 5.7 million families granted forbearance during the pandemic, this is what happened upon expiration of the forbearance plan. So we're going from left to right here. The orange bar, almost 2.4 million people extended their forbearance. So your first initial term may have been 180 days. You can get an extension for another 180 days for a total of 360 days on your mortgage, and 2.4 million families said they will extend their forbearance plan. The next tranche is the blue and the green bars, which comprise of 44% of forbearances, which either were removed from forbearance while they were performing or just paid off the mortgage. These are the people that took forbearance but didn't end up needing it. 500,000 in this group of 44% paid off their mortgage. Now, the majority of those payoffs could be people selling their homes. We just don't know the breakdown. But if it is primarily due to selling, then that only supports the point I've been making for the last few months about equity being the reason we will not have a housing crash. Unlike 2008, people have a lot of equity in their homes, which means they have time to sell if they run into trouble. That's not exactly the right ingredient to support a housing crash. Now, the next bar in gray shows 481,000 people expired while delinquent and are in some form of loss mitigation. And loss mitigation means you are trying to work things out with your bank, and many times the result is a loan modification in which the term of the loan may be spread out over more years to help you make the payments, or the rate could be renegotiated lower, missed payments are tacked onto the end of the loan, etc. In other words, helping people make their mortgage payments. And the last tranche in red is the 80,000 people that expired while delinquent and are not in some form of loss mitigation. These are the ones that may be headed for a distressed sale or foreclosure. Only 80,000 of the nearly 5.8 million people granted forbearance. That's less than 1.4%. What housing crash? What's interesting about this is that when the forbearance plan came into the business, I think the general thought was that we're going to have a ton of people doing this, 30% of mortgages going into forbearance, and then there was this kind of assumption that every one of those forbearances would end up in foreclosure. Well, that's just simply not true, and not where we stand today. Here's what one of the most respected housing analysts has to say as it pertains to the medium-term future. The likelihood of us having a foreclosure crisis again is about 0%. Not a whole lot of room for ambiguity there. Now, I'm not saying we're not going to see foreclosures, period, because there certainly will be, but not at the level of a crisis, a trickle, but not a flood. And so I think that's important to remember as we look at the data, as you have conversations with your clients and prospects, and as you interact with people. Even in our business, I think we may be seeing this flood of REO properties. Help them navigate through that. Give them the facts, forward this video to them if you think it'll help them. Now, as we kind of turn the corner, the biggest issue in our business right now, no doubt, is inventory. Here I go again, sounding like a broken record, but this simply cannot be left unsaid because it is really the thing that could hold back our business. If we're not able to bring inventory to market, we're not able to sell homes. Most recently, only 2.7 months of inventory is available on average across the country. That is shockingly low. I've talked previously about the economic impact of a home sale across the country, and we know that's driving the economy right now. And I think our job is to help bring those listings back to market. If we take a look at the year-over-year change in listings, you can see the green line is the new supply of listings coming into the market. And as this supply comes in, it gets purchased as fast or faster than it comes to the market, leaving this inventory number flat as depicted by the orange line. Hopefully, though, total listings are bottoming out and coming up a little bit, but nevertheless, we are still severely lacking inventory across the country today. And on that note, Zillow just came out with a study of the top 3 reasons homeowners are not putting their homes on the market for sale. And I think this is very interesting, so I want to take just a minute to talk about that. 31% say financial uncertainty is a reason they are not putting their home on the market for sale. 34% say life is too uncertain right now, and 25% of people say they have concerns about health and bringing people into the house due to COVID. There's a lot of uncertainty in people's minds, and you can't really argue with that. It's our job to help people feel more certainty as it pertains to real estate. But it's important to note that there's a cost for waiting, for things to be certain. When things become certain, that's typically after the best window of opportunity to take action. And here's a quote from Zillow to that point. Homeowners who feel life is uncertain right now may think they can get a strong price if they delay selling until they have more clarity. The catch is, waiting to sell may raise the cost of a trade-up, and this falls record low mortgage rates, which make up a trade-up more affordable on a monthly basis, are not guaranteed to last. Now, I'm not saying that rates are definitely going up because there are so many forces in play, I simply don't know. But I can't ignore the reaction of the market to the recent news of a COVID vaccine that was 90% effective in clinical trials and is now headed for mass production, and that this news brought a lot of confidence to the markets, which indirectly and immediately caused rates to rise. We know that we're not going to be in a COVID world forever, so this too shall pass. Question is, will low mortgage rates be something of the past too? Again, I don't know. But I do know that this is not a time to be complacent. Buyers and sellers thinking that they don't have to do anything because conditions are going to remain the same for a while are risking looking back in the rearview mirror and saying to themselves, wow, things were really, really good back then and I should have done something. Last month, I made the case that this is a good time to sell if you're a landlord because another COVID shutdown could affect your tenant's ability to pay rent. And now I'm making the case that this is the right time for an owner-occupant to sell and trade up for all the reasons I just spoke about. Bottom line is that potential sellers should seriously consider the cost of holding out for a slightly better price. It just may not be worth it. Now, as I said before, I'm not 100% convinced that rates will rise, but the Mortgage Bankers Association's most recent forecast has come out, and as you can see, they are projecting a slight rise in interest rates. But don't let that panic you. These are still historically low rates, which will provide the necessary fuel for a healthy purchase market going forward. My point in showing you this is that if the MBA is correct, here's an example of the price of waiting for certainty in the market. Just take a look at where home affordability is today. It's still very high, but is it trending down? And if it is trending down, is it now the time to act, whether you are a buyer or a seller or both? We're still way above pre-housing crisis levels in terms of affordability, and now might just be the right time to act. So as you can see, a lot of things happening in our market, in the world in general, no doubt, but staying on top of it, staying current with everything that's happening is the key to being able to deliver certainty to the clients that we serve. So I invite you to check out this monthly market report, which I put out in the second half of each month. And I trust that if you're a realtor, the information here will help your clients make informed decisions. And if you are a buyer or a seller, consider yourself informed. So that's a wrap for the November monthly market report. I appreciate you listening in. Forward, subscribe, share. I'll be back next month. But before you go, if you're looking to purchase or refinance or know someone that is and would like a no-cost consultation with me personally, feel free to reach out and I'll be happy to analyze if your debt is structured in the most optimal way or if there's room for improvement. Thanks for tuning in. Bye for now.